Hey guys, it's Sasha. The world economy is going through a massive shock in 2022, and one of the big contributors to the shock is Russia's invasion of Ukraine. The stock market crash was already well underway by the time Russian troops crossed the Ukrainian border on February 24th, but the global financial crisis has suddenly got a lot deeper. In the wake of the Russian invasion, EU and the United States have passed a raft of sanctions. Russian individuals linked to the invasion or to the Putin regime have faced asset seizures and various kinds of bans. Russian banks have been blocked from the global financial system and cut off from programs like SWIFT. And more recently, the European Union and the United States have taken additional measures against Russian oil and gas industries, which are the major drivers of the Russian economy. The unfortunate problem is that these new sanctions that have been announced in the last few days are largely self-defeating, because Russia is not going to be the country suffering from these sanctions. Instead, the economies of Europe and the United States are facing an explosive wave of inflation and potentially devastating other economic repercussions, with relatively little impact in the process on the Russian economy. And this is an impossible dilemma. Continuing to trade with the regime that you publicly denounce does not look good politically. It is not going to stand well with the general public. And there is a lot of public support for cutting ties and removing the dependence on Russian oil and gas. But will this public support wane? Will people's perception change if the outcome of this action is a major economic collapse in the West as a result? Russia is a massive net exporter of oil. In 2020, when global demand dropped from 2019, Russia was still producing 10.7 million barrels of oil per day. Russia only consumes 3.2 million of those barrels, so the remaining 7.5 million barrels per day are exported to other countries. The total global production in 2020 was 88.4 million barrels per day, so Russian exports amount to 8.4% of the total global oil supply. And on the surface, it sure sounds like this ban on buying Russian oil by Europe, who is Russia's biggest customer, would massively undermine the Russian economy, but it isn't all that simple when you look at the details. The EU, United Kingdom, and other members of the European Economic Area that have all recently collectively announced measures against Russian oil account for roughly 48% of the total of Russian oil exports. The other 52% goes to countries like China, South Korea, Japan, and a whole host of other countries in Asia and around the world. The issue is that China, South Korea, Japan, and most of these other countries are not joining these sanctions against Russian oil. They have no plans to, because it would inflict significant damage to their economies. The United States only imported relatively tiny amounts of Russian oil, so their sanctions do not really have any material effect. The majority of US oil imports come from Canada, and there are a whole host of other countries that supply far more oil to the US than Russia. On top of that, the United States exports a fairly large amount of its oil, including to countries like China, South Korea, and Japan. And you might be already seeing the problem, because in order to cut the 1.3% of its imports from Russia, the US will aim to increase the internal production in the longer term. But in the shorter term, they either have to increase supplies from other countries or reduce their exports to balance the numbers out. And here is the issue. In general, oil demand around the world is roughly a zero-sum game. Sure, the price of oil will affect the overall demand levels. If the price increases substantially, demand will drop somewhat, but it is all relative. The world is not going to stop heating homes or driving or any of the other uses of oil anytime soon. So if Europe stops buying its oil from Russia, it will simply have to go and buy it from somewhere else. The issue is that buying oil from Russia is massively convenient for Europe. You see, around 15% of the European oil bought from Russia arrives by pipeline, directly from Russia. The remaining 85% comes by sea on oil tankers, the majority of it from two Russian ports in the Baltic Sea, that's Primorsk and Ust-Luga near St. Petersburg, and from the Arctic port of Murmansk and Novorossiysk in the Black Sea. In the recent ban, Europe only agreed to ban oil coming into Europe by sea, but not the oil arriving by pipeline, although Germany and Poland both have announced that they will stop receiving the pipeline oil as well. So that means that about 90% of the Russian exports to Europe will now be stopped by the end of the year according to this agreement, and instead of Russian oil that comes through these existing pipelines or from a convenient nearby port, Europe will now have to get their oil elsewhere. The other big producers who can plug this gap are the United States, Saudi Arabia, Iraq and other countries in the Middle East, and countries like Nigeria, Angola and Libya in Africa. The cost of shipping the oil from these other destinations will be considerably higher, and because of the turmoil in the markets as a result of these sanctions, the price of the oil itself is also increasing rapidly. So what is Russia going to do with the oil that it is not selling to Europe? Well, the critical point is that the vast majority of this oil arriving in Europe is coming on oil tankers, and almost all of this oil is coming from the northern Russian ports, the two in the Baltic Sea and from the Russian Arctic. And remember that most of the oil currently being pumped to Europe via pipelines is not being banned anyway. So Russia will simply continue selling that oil to Europe, just at much higher prices instead. And the rest of the Russian oil, the roughly 90% of what it currently sells to Europe, will be sold in the same tankers to China, South Korea, Japan and many other countries who are not joining the sanctions. The roughly 3.7 million barrels a day that Russia needs to place is well within a manageable percentage of the total demand in these countries. Russia will face pressure because the transport routes to Asia will mean much longer travel times. But there appears to be plenty of supply of oil tankers for the right price, and in fact, Russia has already dramatically increased sales of oil to countries outside the EU in May, and you can see the size of that red bar in this chart increasing. There are a number of tankers currently sat in various seas around the Asian part of Russia, waiting to be loaded. And a recent report by Bloomberg suggests that Russian exports are currently up, running at 3.94 million barrels a day in the first week of June. An additional issue that nobody seems to talk about much is that the world of oil trading is much more complex than people would like to think. The EU imports plenty of its oil from countries like Iraq, Angola, Saudi Arabia, Libya, Kazakhstan, and others. A number of these countries have regimes that are close to Russia, certainly much closer to Russia than they are to the EU. And on top of that, the murky world of oil trading, where people buy and sell whole tankers of oil, whole groups of tankers of oil to make a profit by routing them via weird and wonderful third countries, sometimes holding onto the oil, waiting for the price to rise, you get a whole load of other problems. How do you genuinely go and certify that a tanker of oil arriving from Libya, Iraq, or Angola in a random port somewhere going straight into a refinery is genuinely coming from those destinations? How do you know that a ship carrying the Panama or Liberia flag is definitely bringing you the exact kind of thing that you think you're buying? Good luck with tracking the movement of every barrel. On top of that, a growing number of global oil buyers, including China, are loading oil in tanker-to-tanker transfers at sea. And this practice has been increasing in the last few months, which means Russian tankers shipping oil from Russia to other countries don't even have to complete the full route through the north from the Russian ports to Chinese ports to sell their oil. There are a number of reports that Russian oil is now being sold to Asian countries at a discount. And that is the kind of narrative saying, well, now they can't get as much money for their oil, and that's how they're getting hit. Armed with the knowledge that European buyers are out of the picture, Russia is apparently having to sell oil to these Asian countries cheaper than other producers. There's been a lot of speculation in the markets as to how much cheaper it is, with many US publications claiming it's about 20 to 30% as a discount, and trading data suggests that they're roughly in the right bracket. The price of Urals barrels compared to Brent dived the moment Russian troops entered Ukraine, having been roughly equal beforehand, and now Russian oil trades at around $33 to $35 discount. And given the oil price at the moment is over $120, that is sub 30%, about 28% discount. But here is the thing. Even after applying that discount, Russian oil is still trading close to the $90 mark, which is still a very high price historically, and is still much higher than what the oil price was before the invasion started. And the market price for Urals crude is the clean market version. Given the instability in global supplies, given the uncertainty around the availability of oil, it is very difficult to know what exactly the private deals being struck behind the scenes between countries like Russia and China or other state buyers are. Now, remember that Russian gas is not being banned. It is easy to think that Europe is going all out with the sanctions when you read the headlines, but Europe is currently in no position to ban Russian gas, because that would destroy European economies overnight, because they are so massively dependent on Russian gas for their energy needs. But once again, because of the turmoil in the markets and the increased risks to supply, gas prices have absolutely skyrocketed and are now more than double what they were at the beginning of the year. And in the last few months, Russia has also completed its major new gas pipeline to China called Power of Siberia. And at a recent meeting, Russia and China seem to have agreed to go ahead with 2 more gas pipelines from Siberia to China and from the island of Sakhalin to China. So the unfortunate end result here is that Russia is raking in huge piles of cash from selling its gas and oil, contrary to the popular media narrative. Whatever discounts it is offering on oil are being more than made up by ridiculous gas prices. The ban on Russian oil from Europe will naturally have to reroute global supply chains. Russia will sell less of its oil to Europe and instead they'll go and send it to China. China will buy less oil from Saudi Arabia and Saudi Arabia will send more of its oil to Europe. The new routes will be less efficient, so the cost of transportation goes up and so does the price of oil. Rapidly increasing oil prices for countries in the West mean an unprecedented inflation spike that is hitting those countries. The already exploding inflation is now being fueled even more by these unparalleled rises in energy costs and risks going into a destructive inflation spiral. Central banks in Europe and the United States are rapidly increasing interest rates to try and stem inflation, even though that is potentially a destructive measure in terms of their own economies. The risk of a sharp recession is increasing, and all the while Russia is collecting ever-increasing, record-breaking monthly paychecks for its oil and gas.